I'll say this: if he cuts, the dollar will weaken. I think that there's a lot of fragility in FX right now, and they've kind of got a deal among the central banks that nobody's going to really rattle the cage.
Welcome back to Metals and Miners. I'm its founder and its host, Gary Bohm. Today, we're fortunate to have with us John Johnston, or JJ. JJ was a member of the NY Comex for more than 37 years. He began his career back in 1976 for Continental Grain and then worked for multiple firms, including Drexel Burnham Lambert. He was a founding partner in an independent floor brokerage group in the late 80s and early 1990s. He's currently consulting and writing on Substack under the name JJ ALYOSHA Metals, Miners, and everything else. Give him a follow for sure. JJ, thank you so much for joining us today.
Thank you, Gary. Glad to be here.
All right, well, let's begin with how you view the current state of the markets and the economy.
Well, starting with this week, it's been a terrible month for commodities in July. Everything has topped out and gone down dramatically. Every commodity that you can think of, all the metals, have literally collapsed. Since June, nickel has been down 40 sessions in a row. Aluminum, silver, copper's down 60 cents since July 5th, I think. And the BCOM is down from, I think, 107 to 96, so about 10%. So that, added with stocks falling hard, I just don't think there's anything that's up except for Bitcoin. When Bitcoin made a low on July 6th, and it's up about $11,000. So compared to everything else, Bitcoin is killing it.
That's amazing. Well, there's a few of those things we're going to get into here throughout the discussion. But JJ, in your analysis, what's the biggest risk to the economy and markets right now that you're paying close attention to?
Federal spending, the deficit, how they're funding it. There's a tug of war going on between the Fed and the Treasury right now, where the Fed is trying to suppress inflation, and the Treasury is funding an incredible amount of profligacy with the government. And I think the government has the upper hand in this because the Fed really has a binary tool. You know, they can cut or they can raise, but you know, and everybody's expecting them to cut, and Powell is always a little coy about, yeah, well, okay, a little bit more, and so forth. So I think that keeps some tension in the markets that maybe there's going to be a major change. I don't think, 25 basis points is just so tiny. I don't think it's a big deal, where we have the massive swings in markets, but then, meanwhile, there's this machinery going on in the Congress cranking out paper, and I don't see that stopping, at least not until we get a new president.
So, okay, well, let's just stay on that debt issue for a moment. What is the severity of the risk? How do you see it potentially playing out and harming the economy, harming the everyday American?
Well, you have these little many collapses right now. I think there's a misunderstanding about what inflation really is. The one thing that really costs more money is government. But if you took a look at something like gasoline, on the board right now in the New York Harbor, gasoline is around $2.40, $2.45 a gallon. Well, if you go back 14 or 15 years, or even farther back, gasoline was $3 in the harbor. So if you adjust that for inflation, we actually have a hedonic price of gasoline that's somewhere around $1.25, which would make it, in terms of what we're earning as people and our jobs and our lives and so forth, about where we would be in the mid 80s. So there's no inflation there at all. If you look at the price of hogs, live hogs are about 75 cents on the board. Well, live hogs have been 75 cents on the board every year. You can check it. Anybody else can go look at a CQG every year for 50 years. So if you adjust that, hedonically, hogs are about 5 cents a pound. And corn's trading, around 4-ish. I first traded or saw corn trading for in 1974. So, when someone says we have the worst inflation in 40 years, I kind of think, yeah, well, maybe you can put some facts or details together with wages and CPI and something like that. When you're dealing in commodity markets, that's just not true. Nothing like that.
Are you worried about deflation? Is deflation a significant issue that that could harm the economy, harm jobs?
Well, if we had a substantial economic contraction, yeah, everybody'd be out of work. I mean, first of all, like, with 9/11, no one would go shopping. And Bush went on TV and he said, your patriotic duty is to go to the mall and buy stuff, right? Go to Yankee Stadium, go to Broadway, because everybody stayed home and they were terrorized, which is the object of it. So if we had an event like that, which is always the fear if we have a stock bust like 2008, then, people start liquidating everything. And when you start liquidating things, one of the first things you do is you start firing people. People cost money.
Yeah.
And, you just, I've been there, I've lived it, I'm sure you have. You get fired.
So there's been a lot of chatter over the Fed cutting rates soon, and maybe even as early as this month, but with a 90% plus certainty in September, according to the markets. Today, the market is booming with the Dow up 800 right now. Do you take this as a sign that the Fed is going to begin to cut rates the end of September and the market's getting ahead of it? And if so, how dire do you expect things to be for them to cut?
Well, they don't have to cut. That's the first thing, right? And I can't imagine justifying cutting interest rates into a stock bubble. I know there's a lot of Wall Streeters that want it to happen because they're up to their ears leveraged long with some pretty hot stuff. And certainly that would be good for maybe a brief period of time. But a lot of people, if the thing with it's been good for stocks is there's been a gradual trend. It has, making a lot of new highs this year. I don't know. I saw a statistic that we had a new high like every 4 days in 2024. That's okay because we're not going up, 2% a day. But if we start, trading up $800 a day regularly or 1,000 handles a day, that's not sustainable. And what happens, you get a blow off and it would be terrible. So I mentioned before, Powell is coy. He likes to keep tension in the market, which is healthy. I think if he cuts, we lose that right away. All of a sudden, you're going to have a lot of people that are going to change their thinking, change their, actually add risk. I don't think that's a great idea. I think, there's a lot of balance in the economy right now, and that's to the credit of the Fed. I like Powell. I think he's a good guy. I think he's steady, I guess is the best word for it. And that's a good thing to have because on the other side, where they're legislating a lot of spending, they're well, what's the nice way to say it? They're different.
Yeah. Well, so is it more hot air to jawbone the markets instead of a reality that a cut is coming, or based on the way the market participants are expecting so strongly, do you believe, despite the fact that it's not needed, a rate cut is indeed coming?
Do I think that?
Yeah.
I don't know. I saw a piece on Bloomberg yesterday that it was an article with it was clever that laid out a case for a 50 basis point cut in July. I went back and I looked through a bunch of my notes, because I write and everything. And I last July, they were talking about a 50 basis point cut. right?
Mm-hmm.
And we got nothing. And we got nothing in Sep. And we didn't get anything in December. And there was always a good reason why we didn't. And people were like, oh, well, okay, we'll get it next meeting. Right now, here we are. No one's expecting a cut in July. The market is pricing a cut because they need narratives to validate. I don't know. I, I I don't see how a cut helps us here.
It's why I
Well,
framed it, I'm sorry
okay.
to interrupt. It's why I framed the question the way I did, because we don't really need a rate cut here when you see that they really haven't gotten to the neutral rate, right? So, but unless the economic data is turning really sour and all of a sudden something bad is coming that they could see that they want to get ahead of, then it would, I guess, make sense to cut. That's why I'm framing it that way. Do you think it's going to be? It would have to be pretty dire in order for them to cut at this point, wouldn't it?
No, there's two narratives. Like the Fed's kind of like backed themselves into a corner, saying if we get to if we get to a statistical point where their data, BLS or whatever they're generating themselves, gives us a nominal 2% inflation, then they'll figure like they've had their job, they did their job, and so everybody's going to say, hey, you said when we get to San Francisco, we're all going to get hot dogs. Where's our hot dog, right? And, and I don't think he can welch on that. So what happens when that happens? I don't know. I really don't know. I mean, I still see bidding wars where I live around here in real estate. There's a shortage of houses.
Mm-hmm.
So, they say employment is good, but then you have guys on the web that are fairly smart saying that employment is not good, that it's a lot of part-time jobs. We have other big issues. So I don't know. I think that's above my. I'll say this: if he cuts, the dollar will weaken. I think that there's a lot of fragility in FX right now, and they've kind of got a deal among the central banks that nobody's going to really rattle the cage. Whatever's going on with the yen, I think is done by consent and agreement among the players that are around, because it's one of those things. If it gets out of hand and you have a lot of speculation in the yen, it'll take a lot of mojo to stop it. And I think that's if we ever get around to talking about gold, that's another looming problem. Most of the authorities actually every country in the world has to continue to sell increasing amounts of debt and fund the cost of that debt from additional debt, which means that the weight on the market from everybody is competitive and heavy and growing, and there is absolutely no intention of any of the issuers to pay it back. All these bonds we're issuing out of Congress, I mean, these guys are going to be here for a couple of years or 3 years, or senators 6 years. They don't care. They just need to keep the machinery going while they're there, and they have absolutely no intention of paying it back. So if you get a spike in gold, that is gold's not it's not a little thing. It's a $15 trillion market cap, and it's getting bigger all the time. And one of the reasons why it's problematic is the largest producers of gold are the largest consumers of gold, which would be China and Russia, and their orbital ilk. And all of us, the West, have suppressed gold to a point where it's almost ceased to exist here. So, we mine it, we can sell it, but it's a very small part of the economic pie. So if that got much bigger here, that would be a problem for us. That would be a big problem.
Well, so we're going to dive a little bit deeper into gold here in a moment, but staying on the markets, JJ, outside of 1929, there's really never been a high of concentration of the top 10% of stocks by size versus the entire U.S. stock market as there is today. Does that concentration pose similar risks to today's markets as it did in 1929, and why?
Let me think about that. I think about it a lot, but I haven't really made up my mind. You know, the problem is not so much the stocks themselves, it's the leverage. And technology has made it possible for modern markets to not only become interconnected, but way more leveraged. You know, I remember when we were coming out of the GFC and the Fed was trying to get people to buy bonds. I could be off on this, but you know, and I didn't do it myself, but I heard a lot about it. Margin for $1 million of bonds was $4 per million. $4 to buy $1 million worth of bonds. So, you know, of course, when they're pushing out that kind of money and saying you can buy this stuff, once you impute that kind of leverage into a system, you know, it's very hard to take it out. And all of the money, you know, this is kind of an interesting point. The people who are managing this money, there are no limits to what they can buy in stocks. So whatever they have, whatever money coming in, whether 401k or investment flows, or you and me putting money in our Schwab accounts or whatever like that, all that money goes right into the stock market. But if let's just say you were a billionaire or a multi-billionaire, and you wanted to buy $50 billion worth of gold. So you couldn't do that, really. There's no law against doing it, but if you were to do it, you would have to go through a very narrow set of turnstiles, the gatekeepers, which would be the money center banks. And as soon as you started to buy a significant amount of gold, you know, 10 million ounces, or, well, I don't think you could buy 10 million, but that'd be, you know, 100,000 lots of gold. That's going to go through JP Morgan and Goldman Sachs and Morgan Stanley, and they're going to call the Treasury and say, hey, we've got a big shot down here that's buying a lot of gold. And you would get a call. And the Treasury would say, we don't want you to do that. Stop doing that. If it was Elon Musk or Bill Gates or something, they say, don't do that. And then you'd have a decision whether or not, you know, you wanted to make an enemy of the Treasury and JP Morgan, or whether you were going to back off and not buy that gold. I mentioned this to you in a phone call a couple months ago about Warren Buffett in 1997. I'll just run that down really quickly for your listeners. And in the summer of 1997, I was trading silver, and someone started to buy a lot of silver. We didn't know who it was, and silver was trading around $4, and it went up. And it went up all summer long, from 4 to 5, 5 to 6. And by around January of 1998, the silver market was like pretty freaked out. It had doubled. We were trading $8. Front spreads had flipped into backwardation about $2. And the street was, you know, short a ton of silver. So someone called Bob Rubin, and Rubin called Buffett, and he said, don't do this. Stop doing this. But Warren Buffett said, okay, I will stop. And he, you know, there's some nice clips on YouTube of Buffett and Charlie Munger talking about it. And he wanted to buy 200 million ounces, and he only got 130, and he practically melted Wall Street with that. Because, you know, systemically, we're not equipped over here to handle that kind of activity. And that is that's exactly the same thing everywhere. After, you know, we had the Hunt squeeze and a lot of sugar squeezes and orange juice squeezes and so forth, the CFTC put position limits on everything. So now the most gold you could buy or receive if you were an entity is 6,000 lots. So let me just do the math on that. If you had 50 hedge funds that all but their limit of 6,000 lots, it'd be 300,000 contracts. That's 30 million ounces of gold. So that's 1,000 tons. which would be about $75 billion, which is just what we're talking about now. You couldn't do it, that's no one's ever going to do that, and it would go off the charts. So it's one of the reasons why gold won't go up a lot. In short, is you can't buy it, period. You can't buy enough of it to make an impact, not of a $15 trillion market cap.
Interesting. Let's talk about the consumer for a moment. 39% of U.S. adults say that they worry most or all of the time that their family's income won't be enough to meet expenses because everything has gone up so much. That's up from 28% who expressed those concerns in December of 2021, and similar to the 37% last seen during the 2008 Great Recession. Based on those numbers and the bifurcated consumer, where there's a substantial amount on that bottom 50% experiencing this, how long can the consumer hold on? What do you see happening next?
Well, this is, it's kind of like a red herring, because one of the reasons the Fed raised rates was to make people poor. If you increase the cost of a mortgage or a credit card or anything else that's moving in the system, it's gonna be harder and harder to buy it. And so, it's I've never really understood the consumer, as it were, as a generic group, because I am one. And I suppose if you have to make a decision between food, gas, and the health of your family, you have to go to the government. And that's, I think, a big part of why the consumer is staying alive. There's not a lot of money in the jobs market right now. It's very hard to get a good job, I think.
So you're saying that cohort is leaning on the government to survive. Is that what you're saying?
I think so. I mean, there's an awful lot of I guess here where I live, the restaurants are busy, bars are busy, kids are going to school, but they're getting loans to do this stuff. They're using credit cards, they're borrowing. I don't think and somehow, it's sort of holding together.
But isn't that only for a period of time before some of those spinning plates start falling?
I don't know. I really don't, I mean, so far, we've been talking about this happening since 1986. And periodically we get these blowouts, but somewhere along the line, you have a guy like Bernanke who says, okay, well, we'll just cut rates down to here. We'll do QE. We'll jam a lot of money in the banks. And somehow, it's not trickle down. It's like a fire hose. Yeah. So we're in the opposite cycle right now with Powell. I think there's a lot of restraint, and if things got bad, I think they have the mojo. They have the ability to, come in and
to go all Bernanke fire hose on it.
Keep it all go. The helicopter is what he said.
Yeah.
And being in gold for my entire life, you always think about, the worst case, because that's good for gold. Whenever gold is going up a lot, everybody else is suffering. But I've never in my life, living through 1987, 91, the 90s, which was probably the golden age of America as far as I can. Everything was right. We had low inflation, booming stock market. You could go out and get a job at the drop of a hat anywhere. The exchanges were booming. And then we had a crash in Y2K. That didn't scare me at all. Even in 2008, that didn't scare me. I lost a lot of money on some stocks because I own stocks, but I needed a job. I called around. A couple of weeks later, I was on a flight to Chicago working on a grain desk, and that was after years in gold. But even then, that didn't scare me. COVID didn't scare me. I was confident. So if we have, I guess sooner or later, the stock market is going to have something uncontrollable happen. A lot of people lose money. We'll see some crooks and bad guys and stuff like that. But
the Fed will come in and do something to restore order.
As long as we have I think on balance a free system, and although the political environment has been pretty crazy since COVID, right? I mean, there's a lot of finger pointing going on. There are thousands, millions of people following Trump everywhere, and I don't disagree with a lot of the things they're saying, but that's the healthy part of America, that we have Trump. We should be grateful that we can have a country that tolerates that and the other side, the polarity. You think, oh, it's the end of the world. Biden's an old man. He can't think who's running a country or anything like that. Well, whoever it is, country's running. Things are going along. Not perfect, but, so it's as long as we have a relatively free society, and I doubt that we'll give that up. I hope we don't. I'm not really afraid of stocks, having a bad period or the economy. Sorry.
Okay. No, you're fine. You're fine. JJ, post-World War II history dictates that it's not until the Fed actually lowers interest rates that the stock market corrects. So do you expect the market to rally into the first Fed rate cut and then correct if history is any precedent?
I think it'll rally if they cut. But I don't know how sustainable it'll be at this level after going vertical since 21, because they put $6 billion in there. They had to go somewhere. And so, now at the top of this is why I think it's kind of a stretch to think that they're going to, cut into this, because they need this 5% as their piggy bank, when things get dicey, and at these prices, things could get dicey. So
but then there's the wall of debt, and servicing the debt at 5%. That's pretty expensive to the budget. But I guess they could just continue to run the fiscal dominance playbook, right?
I don't think they care in Washington. They're very temporary people. We care. We have to live here and pay for it. But the politicians, they're very temporary. So, and I think that they're going to keep borrowing and spending until someone stops them, or until the market stops them. And that could be sooner than we think. The market will hike rates whether Powell cuts or not.
So, yeah, and they have done that before. So the S&P 500 recently closed down more than 2% for the first time in more than 350 days. What does the end of that streak mean to you, if anything?
I watch it happen. I've read some very smart guys talking about seasonality in August, where people, withdrawals tend to be common and large for that part of the year. So there's not going to be any money coming in cyclically the way the money flows go. The stock market is very, very long, and this little blip hasn't really changed that. I don't think we've seen selling of shares, but I think we've seen some downside protection, which puts a lot of gamma in. But I don't think anybody's really hitting the bid. Obviously today, I don't know why they got so crazy about PCE. really wasn't like a great number, but August could be bad. August could be a bad month.
So, JJ, there's a chart that's recently gone around showing U.S. tech stocks have raced past their earnings similar to the late 1990s. I don't know if you've seen it, but with that in mind, do you see a similar outcome potentially as the dot-com crash to hit the tech companies this time around? I want to point everyone over to our Substack. It's free. Go to metalsandminers.substack.com. We post free content on the consumer, economy, markets, artificial intelligence, individual metals and miners, and every single expert interview that we conduct, just like this one. They're all up there. And when you subscribe, we want to give you a free gift. It's a report that we wrote based on the important Ray Dalio foundational premise. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." This free gift is a must-read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address to subscribe and receive the free gift on us. Also, I'm positive that you've enjoyed this conversation with JJ as much as I have. Please let him know. Hit the like and subscribe button and leave a comment below the video.